like in 10 years, if you had to build a portfolio and say, 10 years from now, this is the portfolio I want, what would it look like? And the key part of that statement is you have no idea what the world's going to look like in 10 years. You have no idea if you're going to like stocks more than bonds, if you're going to like commodities, if you're going to, you have no possible active view in 10 years. And so think of that as your definition of passive, as your definition of beta. Build the best portfolio you can that you'd be happy having it in 10 years. And then think of active as everything that you do between now and then.
Okay, today everyone is going to be very excited to see we've got Chris Schindler back in the hot seat from Castlefield. Chris, how you doing today? How's Toronto?
Not so bad right now. 1 or 2 degrees better than last week when it was about -10 and snowing. So probably not quite as nice as where you guys are.
That's possible. It's pretty gray here today too, but no snow on the ground. You'll be happy to hear.
Oh yeah.
For those who don't know, we've had Chris on 2 or 3 times in the past. They're always crowd favorites. We go broad and deep. Chris's background, we'll obviously give a more detailed background or bio for Chris, but worked at one of Canada's major public pension plans for many years, ran their quant desk, and has spun off into his own quant hedge fund, primarily trading global futures markets. So we're going to cover a variety of topics today related to his past and his present, potentially his future. And so let's start with
Well,
what we're
let's not hide where he's at. It's Castlefield. That's the name of the
Castlefield,
firm,
that's right.
right?
Yeah.
And
Yeah.
where is there a website? Is there just let's get it out there at the beginning too? Is
I mean, there's a website that has, I believe, a phone number and an email address, and that's about it on it right now.
oh
So,
nice,
it's
very very
very professional.
takeaway close there.
exactly, yes,
I love it.
the scarcity close.
That's right.
Right. So let's start with what we're currently facing. It's funny because I think our first chat was probably in 2020. We had this crazy concentrated tech rally. Actually, it was kind of like this meme stock, low grade, low quality
right.
tech rally. And we're sort of back in a way to where we were there. We don't have any SPACs to contend with at the moment, but we're back into that massively concentrated, technology-oriented large cap rally that we experienced for much of the 2010s, certainly the back half of the 2010s. So I thought it might be useful to kind of revisit that period. I think a lot of people who've only been investing for the last 10 or 15 years have only really experienced an environment where US and especially US big cap tech was really the only game in town. Do you think we're back in that kind of environment? Or, do you think there's gonna be a lot more opportunities over the next decade than we experienced in maybe the previous decade?
Holy moly, you guys come in swinging it. Yeah. So look, and I guess you don't go back to 2010s. You can go back to the 2000s or the Nasdaq bubble
Yeah.
when you really want to talk about concentrate.
Yeah, I mean, that was interrupted, right? For that
Yeah.
2000 to 2012 period,
Yeah.
right? We
Well,
had this
especially
emerging
in
market.
Canada. I remember a huge problem for anyone forced to benchmark to public markets where a public market index where if you wanted to hold a Canadian index, you have to have like 30 or 40% of your weight in your town.
Yeah.
And so there's obviously a lot to this question, and do these environments show up? They obviously do. We've been through one. We absolutely have been. The futures have been hard to predict, but you can kind of point to some features of tech that make it much easier. I think, to explain how it can get so concentrated and how it can get like what looks bubbly at times, I guess, as well. And part of it, I think, has to do with just I think it'd be pretty hard for someone to just say, I'm going to start up a new business and turn it into $1 billion show in a couple of years. But like, obviously with the infinite leverage of technology, especially, online technology and the huge scalability, you can create these huge potential future businesses, almost out of like, it feels like out of nothing. And, and they're so hard to value. And right, part of the problem with the NASDAQ bubble was, um, like everything looked reasonable. I don't know if stuff looked reasonable or not, but you can imagine when this one company, if it succeeds, could be massively successful and could be massively valuable. But the challenge was all 10 or 20 of them couldn't be. And
Right.
so you had situations where, individually it might make some sense if you didn't get a sense of the context of the entire, space or sector. So that's part of the problem. And we've seen that over and over again where they can't all succeed because they're together, they're making a bigger claim on future, like ec- economic growth or future wealth that is impossible to exist. And so together, like all these valuations can't make sense. And then you're going to figure out, well, like, does the entire index have to reset, or do you have to go after the individuals and figure out, which ones will go, which ones won't? Because it's so easy looking back to say, man, these are $1 billion companies, but if they're the 1 in 50 survivors, or if you got entire spaces that just didn't work and went to zero, it's much harder to predict that going forward. But
Yeah.
and like, I mean, obviously that's the challenge. Um, and I guess the other thing is because a lot of these businesses, and I understand, um, I'm talking about more of the ones that we just don't know what they're worth yet, because some of their cash flows are way out in the future. They're kind of, well, they're almost like a private equity firm that's marked to model. They don't have anything that really moves them up or down, sort of on the day to day, and they're just based on some future possibility, and that leads to 2 or 3 really weird price dynamics, which can lead to this concentration. The first one is like when you have, uh, analysts, and I think that there's a fair amount of evidence that analysts tend to crowd with each other. And strangely, the more volatile and uncertain the stock, the more they tend to crowd with each other relative to the volatility, because they have this benchmark risk of being benchmarked to their peers and looking wrong relative to their peers. And so you actually find that for really uncertain stuff that's like really high vol, that they crowd even more. It creates more of these crowding effects, and you get more of these sort
Right.
of bubbly effects. And so that's like part of it. And that leads to momentum in these names, which can really happen. And of course, they drag retail in along with them along the way. Um, and you can put that up against what feels like almost a totally different statement, but I think they actually kind of work together, which is when you have a dispersion of opinions on something, just straight up, but like, and I'm not talking about like analysts all crowded together. I mean, like actual people in the market who are betting actually have a dispersion of opinions. Like Captain sort of assumes that everyone has homogenous expectations, but like that's clearly not true. And as soon as you allow for heterogeneous expectations, you get these sort of weird effects where the more uncertain the outcome, the more the price gets pushed up. And I don't know if you guys have seen any of these papers, but I mean, this is sort of is this making any sense to you, or do you want me to go into this bit more
Yeah, don't
detail?
worry. Definitely
Yeah.
keep going. Yeah.
Yeah. So, uh, imagine if you had a world where, there's some people thought a stock was worth 101, and some worth 102, and some worth 103, and some worth 99, 98, 97. And you kind of think that in a perfect world, it would settle at what the average dollar thinks it's worth. And we've had this conversation a lot about privates, because it really, really shows up in privates. And in private equity, it's the most extreme form of this. The price doesn't settle at what the market thinks it's worth. The price settles at what the most wildly optimistic person is willing to pay. So, if someone's going to buy a house, and the market thinks it's worth 1 million, and some people think it's worth 800, and one guy goes, it's worth 200, or it's worth 2 million. It sells for 2 million. It sells for and so prices push off to the right when you have dispersion of opinion, when you can't short the price back down to zero. And the privates cannot be shorted back. So they go all the way to what the most wildly optimistic person is willing to pay. But if you have a world where you got more longs than shorts, or you have not enough shorts to pull the longs back, and we're always in a world where there's a long bias. There's more potential long buyers than short buyers. Then a dispersive opinion is going to bias you towards the tails and to the right tail. And so the bigger the dispersion of like I don't know what this thing is worth, and some people think it's worth nothing, something is worth a ton, that pushes you to the right as well and creates a bubble in that space as well. So you can kind of see how the massive uncertainty of these things will result in a bias high and momentum, which we see all the time. And so, does it, so you can push all of that against, it makes it pretty risky against, I think, like one other thing you have to pay attention to, and like, look, there's always crazy issues when you're doing market cap and market cap weighting, and people have that as their benchmark. right? The challenge with market cap as your benchmark is that it can be an incredibly painful benchmark. It's because if the small number of names do extremely well and you're anything other than the market, you're going to get it's going to crush you at times. And there are going to be times when you crush it because it does badly, but it's a really inefficient benchmark in a lot of ways to measure your performance against. But it is what people do measure performance against, and so you get these benchmark issues associated with. And and so like there's a whole universe of quant, and how do we think of an alternative to market cap
Yeah.
indices, and think of them as processes and benchmarks, and this is going to go on a total left turn, by the way, here.
Take it.
But I spend a lot of time thinking about how do we alternatives to market cap weighting, because you do get this massive concentration risk in a small number of names. And the most naive alternative to market cap weighting, which for sure eliminates any kind of mega cap bias, is just to equal weight things.
Mhm.
And it's actually, in the very long term, a surprisingly strong solution for equities is just to equate all the names. But it's shockingly naive. And it's got, so we did this. We ran an alternative to, to market cap weighting. We ran an equal weight. And the problem, and there are lots of problems with equal weight, but what it does do is it says, I don't care what anyone thinks this is worth. I don't care what the market thinks it's worth. I don't care. I'm just going to put $1 in each of these things, and so be it. Now, lots of problems with that. But one of the ones that always bugged me about equal weighting anything was this definition of, well, what's the thing you're equal weighted? I mean, you could say, imagine I'm equal weighting countries around the world, and I'm going to put $1 in the United States and $1 in Canada and $1 in France. And then imagine the United States breaks up into 50, independent little countries. And that thing that used to have $1 in, now I'm going to put $50 in it. You're going to bet 50 times as much on the exact same thing just because of how it was defined. And you have this problem with equal weighting, which is called the unit problem of equal weighting, which was how do I think about what's the unit? Because clearly it's a definitional issue. And if things come together, or if things split up, I'm going to completely change my weightings based on what shouldn't change my weightings. And that's a big problem with equal weighting. And so market cap weighting, it's got a lot of efficiencies to it. It's got a lot of, like I say, efficiencies. It's got theory behind it that you can kind of stand by. But at the end of the day, it's people's opinions about things. It's the whole market's opinion about things, but the price does move on that. Equal weight's got this definition of independent unit problem. And so there's a subcategory of things in between them. And so this is the sort of the three categories of alternative indices we created, what we call kind of a fundamental value weighting. Right. And a fundamental value weighting is different again, because it takes something about the companies. And so, Rob Arnett, I think, is a guy who's really covered this a lot, but he would say, it could be anything. It could be a number of parking spots in the parking lot. It could be a number of employees, but it's typically revenues or dividends or cash flow or something that kind of speaks to the size. And he
Something
doesn't sell it this
oriented
way.
more towards a fundamental criteria rather than
Biases
just
it.
price
And so
times.
you think about equal weight, and equal weight's got one extra really, this is totally off far now, but it's got one really cool feature, equal weight, which has got called an energy capture or a volatility capture. Because if you have a number of companies that are equal weighted, and you always have error terms, you have surprises, surprise the upside, surprise the downside. And what a market cap does, or if you take an equal weight and you don't rebalance it, then the companies that get surprised the upsides grow. So they have positive shocks, and the companies that have negative shocks shrink. And you end up overweighting the ones that have positive shocks and underweighting the ones with negative shocks. And if there's any reversion to the mean, and so if prices project those further out, if there's any reversion to the mean, then you're kind of backwards of what you'd like to do. What you really want to do is buy the one you expect to revert back, and you want to sell the one that's had a positive bias. And market cap was the exact opposite of that. So anytime you equal weight, or anytime you rebalance to a starting process, you're going to capture some of that natural mean reversion. And in fact, a huge proportion of a lot of quant, alpha and value add, is in fact that energy recapture. And so I think Rob Arnett was able to show, I don't know if he showed this or someone else did, but you could take the inverse of his portfolios, and they also beat market cap, just
Yep.
because that energy capture is pretty helpful. Anyway, but so one of the things that any kind of fundamental weighting does is when the fundamentals change, you buy more or less, but it doesn't move the price because of people's opinions, because the market's opinion projecting that into the future, because that projecting into the future tends to cause issues. So, but And if he's never sold it as this, I've never really seen it presented this, but the reason I like this idea is if I took a company and I split it into 10 pieces, I will still have the same amount of weight in that new thing split up 10 ways that I would have on the original, and vice versa. And so it's kind of an equal weight, but it's an equal weight by size or something a bit more fundamental than just like this equal weight. And between those, now you start to say, how do I invest in a market that's got, some very, very concentrated companies in it? And you have to take a step back and say, if those concentrated companies were in fact 100 companies that came together, well, maybe it's not so bad. Maybe that is, well, like it's a quarter of the weight, but if it was a massive conglomerate that brought together, maybe it's not as concentrated as I think it is.
Mm-hmm.
But if it's a single thing with a small number of risk factors just blown up a massive size, that's when I got to be more worried about. And so we start to think again, which is like, how do I determine how many effectively independent companies are in that company to get a proper sense of how concentrated it is? And I'll just say there's a lot of topics in that, but just like, is there a fundamental reason why tech, and especially tech with earnings that are being projected way out in the future, is way harder to value? Like, absolutely. Does that result in trending and possibly higher prices that then have to correct and disappoint going forward? Like, probably. Does that mean that is Google a single factor, or is it a conglomerate? Or how do you think about that? I think you got to get a little bit deeper before you're saying this is a massive tech concentration, because Google's a tech company, but it's also an advertising company. It's also, it's a media company. I mean, maybe it's a bit more, maybe it's not quite as concentrated as it feels.
Well, some of them are more concentrated than others. I mean, obviously Microsoft is exposed to virtually every sector of the economy. It's a massive global conglomerate. Same with Google. NVIDIA reminds me more of like a Nortel or JDS Uniphase, right? Remember JDS Uniphase with their optical switching, and everyone assumed that the internet was going to have optical switching, and that was going to be the tech that everyone settled on, and JDS Unified just went to the moon. It's these kinds of concentrated bets on these narrow tech outcomes that become especially risky, right? But I mean, just from an advisor standpoint, how do you manage this and manage client expectations? It terrifies me to see investing in global cap weighted US equities above 60% of global cap weight now, and 7 companies worth, up almost 30% of US equity valuation. Like, it's just that you just have this sort of, you're going on this massive amount of faith and taking this huge concentrated bet. If you don't, you risk being totally left behind. If you do, then you're taking this concentrated bet. It feels like a no-win situation. I mean, how do big asset managers deal with this, especially when they're benchmarking against peers on a year in, year out basis? Like, it seems like it's just a hard problem.
Yeah. And the challenge, and I don't know how you break it, but the problem with it is the benchmarking. At the end of the day, if you are always going to compare someone to something, then they are always going to have to look somewhat like that thing. And instead of being a maximum Sharpe ratio investor where they're trying to make as much money for as much return for as much risk as possible, and that you've forced them to have a different definition of risk, which is their tracking error to the benchmark, and their optimization becomes return over tracking error to the benchmark, which is like fundamentally like much less useful thing. And it's much less useful for you. And I say, like, when typically I say you're looking for managers, and I think you just have to get comfortable with, if a manager's properly a long short space, they should have no beta anyway, and you shouldn't care. You literally should just say, I've got my, and whether I'm talking about as a portfolio constructor, how much of this stuff do I want in my beta? You separate that question out for a second and say, let's say I've somehow made that decision. Then for my managers, I should give them the right benchmark, and I should give them the right risk definitions and the right governance, and so that this doesn't affect them at all. They have a good stock pick over here, and they should make it regardless of what the beta is and is doing. Now that's a pie in the sky kind of nice statement. It typically doesn't go that way. But even for, even just saying, like, I'm investing my money in this beta, what do I do about it? And it's funny because when we first started looking at this and how to think about weighting countries, and I think we're doing this research in the early 2000s, and the country that really stuck out in the history, the last 20 or 30 years was Japan, because Japan in the late 80s had looked exactly like the US does now. It was a massive portion of MSCI. And of course it got super expensive. It was like, and there was all the tiger funds and everyone was just throwing money into it for 15 years, and it got so expensive, and then it just broke. And it broke. And if you were, MSCI weighting Japan, you got crushed. And if you had, underweighted a bit, you did well because you had a very, very large concentrated exposure to a relatively small subset of the universe. And, I think over the very long term, these moves tend to punish you, and you tend to want to disperse it because there's always the mixture of the fundamentals and then the market mania behind it. And the market mania behind it is the piece that always over projects. And any market cap weighted, which is a mixture of the fundamentals and the market's projection about into the future, is almost certainly going to lead to over projections. The problem is, can you survive in the short run long enough leading against that to prove your thesis? That's the tricky part.
It's the combination of this overvalued market and a strong trend, right?
Yep.
So, and this is where it gets really dangerous, because when the overvalued market trend turns and increasingly you get that larger and larger spikes in volatility where the dip is bought until such time it's at 25 or 30% and the dip isn't bought, or it's only bought up 10 or 15, and the trend is now changed and different. And the world of investors is always sort of slower to pick that up in the final trend change. And then you have this exposure, this overexposure to the largest market just by the market cap chasing, and you have the risk unwind. And so that's, the valuation side of it is important, but man, when the trend is strong, it's a really hard problem.
Yeah. And which I guess when you're saying the trend is strong relative to the valuation, you're also, to put it another way, you're just saying the behavioral side of
Right.
things.
It's that momentum that, that punching fist through the enthusiasm that continues. And as long as it continues, the valuations don't matter. I mean, it's expensive. It's not as expensive as it's ever been. It's not as expensive as Japan was. And we don't know if any of those are even limits on how expensive something could become in a strongly trending market.
Yep. So, and that's exactly it. And so then you end up with, sort of various forms of this, which is like, look, you can stay along the trend, but you've got to be aware that the more crowded it gets, the quicker, sharper it can turn back on you, because there's like a growing liquidity buildup, and there'll be a growing liquidity rush on the way out. I think my guess is a lot of players get that. I don't know if the retail side sees it as clearly, but I think a lot of players get the growing riskiness of it. But there's always that, you have to keep playing while it's still happening, and it's because it's just so painful to lean against it. So, and it all comes down to, it's a benchmarking problem.
Did you
Without
ever
a
do
doubt.
any work? Did you ever do any work internally on the double exponentials, like as the curve approaches a certain level of criticality and the fractals and all that kind of stuff? I forget the name of the French mathematician who was mapping all of that, and he worked that paper.
But
Go ahead.
Malbrat?
Or
what?
He's one of them, but yeah.
Mandelbrot. Is that the one
Mandelbrot would be one of like the fractal guys. But yeah, so the I mean, yeah, that's a big. So I mean, when markets go parabolic, the issue is always well, like, like it's the same definition of anything. It's like a bubble is really easy to see after the fact, after it's popped. It's very, very hard to know if this thing that's running up, is that the bubble yet, or is it the peak of the bubble? And Jeremy Grant of GMO has done a huge amount of work on trying to just, he's based on all bubbles mean revert. But the challenge with that is, after the fact, yes, all bubbles mean reverted, because you kind of defined it as a thing that went up, that came back down. Microsoft or Apple, just, are they bubbles? Well, it's hard to say. They kept going for like 15, 20 years. And so, I mean, maybe at some point in the far future, you'll be able to look back and say, yeah, they were bubbles, they mean reverted, but it's, I don't think it's quite as obvious. And so he tries to define bubbles relative to fundamentals, but the problem is they mean revert or the fundamentals catch up. And it's one of those two.
And the story always need to have a plausible outcome where the fundamentals could catch up. I mean, there's very good narratives around why, Meta, Google, Nvidia, Microsoft deserve these ultra premium multiples, right? The new story is AI and all the compute that's going to be required. In 2000, it was internet and switches and all that kind of stuff in Japan. It was their Six Sigma manufacturing process. They were going to completely dominate global tech manufacturing and auto manufacturing. And, that all got swept up in their banking sector and the real estate sector. I remember in 1989, the Emperor's Palace in
Yeah.
Tokyo was valued at a higher total valuation than all the land in California, right? Like, and
Yeah.
there's a plausible reason for this every time, right? And there's this potential every time for this time to truly be different. Maybe fast takeoff AI actually does um, mandate this kind of overvaluation. Maybe software, Mark Andreessen said software eats the world. Maybe this is the time when software eats the world. Like, there's always got to be this plausible explanation in order for the markets to rise to this kind of bubble level, right?
Maybe,
that,
but
that
then you see, it's like unless it's also an incredible like just creator of mass wealth for everyone. You can't plow this one up because of potential ability to grab the future pie and still keep these guys. There has to be like once again, you got to add all of what like those growths require what kind of earnings and what kind of cash flows of what kind of percentage of the total world pie at some point. You go, does that make sense? Because if they're claiming 2x of what it will ever be, then no, those things don't all add up. It's just the question is like one of those 10 may be correctly valued. Maybe it goes even bigger.
Yeah.
But that's obviously, yeah, there's always a story. There's no doubt there's always a story. And it has to make a bit of sense. And it can make a lot of sense. And we all heard the stories, like all the way through, like through the years and through the decades, we've heard the stories. I mean, I guess NFTs had a story. It doesn't necessarily mean that they're going to hold their wealth when the story moves on to someone else.
the
And
other thing is the initial conditions they're important and they're different, right? 1990, you had a significant earnings contraction, yet the market did not go down. The early 90s, the S&P kind of sailed through whilst earnings were contracting. I mean, yields were high and it looked over the recession almost. And so you also don't know what the initial zeitgeist of the market is when
yeah,
you go through the transition. There's so many dimensions to this. It's mind
yeah,
boggling.
well, yeah, no doubt. And I think, like especially with Japan peaked in 89 and I mean, I'm going to make up some numbers, but I think like 15, 20 years later, its stock market was down. I can't remember, like
It was like
90%. And,
70%.
and like it was so much, and its real estate market was down 95%. It was just unbelievable crushings. Um,
It's only
but
approaching those numbers today.
yeah, it's just
But
getting
it's
back.
just getting back to that.
And I think like from like 2000 to 2010, I think Japan's earnings growth was faster than the US's. Like it's like starting points really matter. And so, and whether or not, and you guys see this lots of times, it's like, and you think about like risk parity stocks versus bonds. And you go if you just went like, imagine you make some magic statement. It's like, they both should have the same Sharpe ratio over time. And maybe that's true. Maybe it isn't, who knows? But like, if this guy runs off at a Sharpe of 1 over the last 10 years, it's either getting ahead of himself or catching up. And I don't know if you really know, because at the end of the day, I mean, who's to say? Or maybe a bit of both. And it's either getting in front of itself and you should sell it, or it's catching up and it's a good deal. And I guess that's kind of like a risk parity statement. It's like, if you were, if the only two things you can invest in the world were stocks and bonds and you had them, would you care if this one happened to take from this one and then this one happened to take from this one? If you have both of them, I guess you're probably kind of fine. So if you have the world and the world is taking from here to give to here, as long as you've got a well-diversified basket, maybe you don't care as much.
Well, and then
As long as you do that right.
you've got periods like 2022 that sort of, makes a bit of a mockery of that stock bond diversification, right? Like this, own some stocks, own some bonds. The idea is the bathtub, there's always a drip into the bathtub. And so the level is always rising, whether it rises more into equities, that doesn't really matter, versus bonds because you own them both. But when the, that bathtub sort of contracts, the levels contract, then, you've got stocks and bonds both losing together, right? Which is why stocks and bonds, the two-legged stool typically doesn't doesn't balance, right? You've got to add that third leg.
Yeah, I mean, at least I guess that. So the statement there was like, if stocks and bonds were the only two things, and you
Right.
had, I guess, a world
Exactly.
where
Yeah.
you
Yeah.
could lever, delever. Yeah, like I mean, obviously, when we first started our risk parity work, I mean, the very first thing we did is when stocks and bonds are dangerous, like hugely dangerous, and that would be a crazy dangerous risk parity process. And assuming correlations are static and either zero or negative is also massively dangerous. And so, if it's going to require some dynamicism, and it's going to require some dynamicism on risk and correlation measures, and it's going to require other stuff because, and I think I presented this a while ago, because I know I gave this presentation back in 2018 when the last thing anyone in the world was thinking in 2018, you got to really stretch your mind back and remember, but it was like people were still kind of freaking about deflation at that time. And the last thing anyone was thinking about was inflation.
Yep.
But it was, uh, it's just always, inflation is always a risk, and discount rate shocks are always a risk. And so building a portfolio that's resilient to inflation shocks and discount rate shocks. Inflation shocks is easier because you can put some other stuff. You've got some, some gold or some break evens or some, commodities. There's things that you can put together to get a decent attack on inflation. A discount rate shock, that's itself distinct from growth and inflation shocks is much harder to defend against. Because,
And we just
as you
haven't
said,
had very many inflation shocks over the last few decades. So, hedging against inflation or owning assets in a portfolio that are designed to do well during higher than expected inflation shocks has kind of made you look silly for a long time. You get these sort of periodic spikes where it pays off. And then you go through these long stretches of sort of this, or at least you have over the last few decades, gone through these long stretches of disinflationary growth. And, any effort to diversify outside of stocks and bonds kind of makes you look silly for a long time. And then, you get this spike and that sort of pays off. But it's just the investors haven't had much experience with that level of diversity paying off over the horizon that they've been managing money or had money invested in markets. So it's hard.
sure. And y- totally right. To that, I guess I would add a couple things like, and I can't remember what I presented. I was probably going to recheck my old podcast before I came on, but the, uh, inflation, so something like a break even, while it should respond, and it responds to a certain type of inflation shock over a certain time frame, which is not necessarily what you're always worried about. Um, Probably has a negative expected return over time though, as a trade. And so if you think about the things that like you mentioned, where you go, I want to have a positive expected return because I want it to contribute to my total portfolio, and yeah, like it's going to be spiky at the right times. And then how do you build something that's inflation sensitive that has more of a smooth positive return over time while still covering your inflation shocks? And that was the big, I think, sort of effort in saying, first of all, like when we built our inflation sensitive asset class against all sorts of pressures, saying like, why would we bother? The answer was because it's a risk and it could happen. And so whether or not you think it's going to happen, let's call that year in alpha on this whole thing. But portfolio construction at the portfolio level is just, I want to build things that are resilient to a variety of outcomes, regardless of who thinks what's going to happen. I call that like a beta portfolio construction. And even then you say, what's inflation? And everyone's got a different definition of inflation, right? Economists might say it's a CPI or, wage inflation, or they might say it's monetary inflation. A lot of people will say it's monetary inflation is the correct definition of inflation. Um, if obviously, as we saw in the 70s and the late 60s to even early 80s, inflation can be driven by commodities. And it's called supply side inflation. And if the price of commodities like go up by 4 times, well, yes, that's going to be massively inflationary if it's persistent and it's across the set. And so for each of those different definitions of inflation, you actually need a different basket of assets to handle them. And so for monetary inflation, like what's your best defense against monetary inflation? I don't know. There's a variety of things you can think about, from real assets to gold.
Yeah.
If you're looking purely at a definition of something like CPI, or then maybe a real return bond or a break even is a better focus on that. If you're looking at like a source of inflation from the energy side or from the ags or from commodities in general, then obviously commodities are the best source of that. We built a very broad basket inflation sensitive set of assets because we thought inflation can be, there's lots of different definitions, there's lots of different causes. But the reason you care about inflation and the reason you need this asset class is because in general, inflationary shocks have a deleterious effect on most of the other assets in your portfolio. And so there's going to be times when your other assets get hit, especially your bonds get hit by inflationary, like unexpected inflation, but so do your businesses. And so, if you think of your equity in your businesses and your, are generally exposed, you need something to protect you. And then the real question is, well, how do you build something that protects as well as possible, but still has a positive drift to it? And so that's where we kind of built a quant program or a systematic program that does that. Right. And you can start to think about, if I got these, like, what am I trying to do is I'm trying to cover inflation, but I'm also trying to get the positive risk premiums and drifts in the commodity space. Well, then you got to dig a bit deeper than just going long a couple things. And that once again requires a bit more expertise, a bit more specialization, and a bit more leverage and a bit more like effort. But ultimately, I think something that can be really, really helpful for a lot of investors.
Yeah,
And it just comes down to, once again, like if you thought your bathtub was just stocks and bonds, yeah, you're going to get exposed. The risk parity world is really like, it's that statement of like, if it's just money sloshing around, and if somehow you could own a bit of everything, then in that world, maybe you're kind of okay.
right.
But then that goes like, well, that's great. Money's sloshing around and every single investor wants to get that alpha. Like, I want to time that. I want to add value by getting in front of that sloshing or avoiding the sloshing and of course that's what all active and macro and everything is trying to time the flows of money around. And it's yeah, stocks and bonds and commodities. If you got that, if somehow that was your entire bathtub, that's great, but I'd still like to capture some of that energy between them. And that's where, I think where a lot of the fun is.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsalt.com. Now back to the podcast.
So speaking of alpha and trying to generate it, we spent a lot of time, debating where the greater inefficiencies are, right? And the more sustainable inefficiencies are. And we've chatted a little bit about Samuelson's dictum on this program a few times, and whether there's a greater opportunity to generate alpha through security selection or in the macro space. Just in terms of hedging inflation risk, like, do you think it's conceivable to be able to manage inflation risk through more effective security selection? Like, can you just select a diverse basket of equities and or credits that make you more or less resilient to inflation, and you don't need to have that third leg of the macro stool?
That's interesting. So Samuelson's dictum, that's the micro efficient, macro inefficient.
Yeah.
Um, yeah, I mean, that's an interesting statement. And I think it's one of those things that, I can just like quickly something to say about inflation. I would kind of think of, what you just said there is like, if I stock pick correctly, can I create, like, can I cover inflation from credit and stocks as opposed to
Yeah.
having to go into commodities? And yeah, I mean, there's probably some inflation sensitive equities and I think, you can probably find things that have some inflation sensitivity. Is that something you would add to your basket of inflation sensitive assets? Yeah, probably. I think you have to be careful. And this is, this is just an alpha beta separation statement, but like if you think of like portfolio construction as I'm going to try and build my portfolio and I think of passive, and we've had this conversation before, like what's passive? Like nothing's truly passive, and what's beta and my definition of beta like goes all over the place. But if you say one definition of it is like, it's going to do what it's going to do, regardless of what anyone expects it to do. And so if you put money in it, doesn't matter what you think this is going to do. If you just leave it, it does what it does. That definition of beta Well, if you go, I'm going to put my betas together to try and create the best beta portfolio possible. There's obviously some active decisions there, but let's say there's like, not as much timing. Then you need pieces that interact with each other in a nice way. And,
Yep.
and if you're leaning on your ability to see the future and stock pick correctly to cover your inflation risk, that's a little bit different. That's like saying, like, if I can see the future properly and I can call winners and losers, then I don't have this risk because I can see the future. And it's like, well, maybe you do, maybe you don't. But that's an active management, and you're now relying on active management to cover your inflation risk. And I would say you should do that as well. But when I think about how pieces of my portfolio interact and portfolio construction, the way, and this is how we sold it to our board. And I think it's a really interesting thought process when you talk about your portfolio, your beta. We said, what's the portfolio you want to have in 10 years from now? It's like not over the next 10 years, like in 10 years. If you had to build a portfolio and say, 10 years from now, this is the portfolio I want, what would it look like? And the key part of that statement is you have no idea what the world's going to look like in 10 years. You have no idea if you're going to like stocks more than bonds, if you're going to like commodities, you have no possible active view in 10 years. And so so think of that as your definition of passive, as your definition of beta. Build the best portfolio you can that you'd be happy having it in 10 years. And then think of active as everything that you do between now and then. And it's like, well, I have a view over the next month, or the next 2 months, or the next 5 years, and start to layer on that. But your center point, your starting point should be that thing that is the most unaffected by your view of the future, because your view of the future, make those bets and decide how much risk to put in that bet based on how confident you are in your ability to see the future, and do that. But just understand that you could be wrong. And you might not see the future right. And you might not have that ability. You might not be as good as you think you are. You might be better than you think you are. Who knows? But separate those two pieces out and build the best beta you can. And that needs assets that interact well together, regardless of your ability to call the future. And then if you want to try and add value through active management, absolutely do that. If you think part of that value is alpha and part of it is inflation protection, however you want to define that, for sure, go for it. Size it right, but separate those decisions out. Does that make sense?
The nice side effect there, Chris, the way you explain that is now you also have something to measure your active bets against. You have this, let's call it unbiased, do no harm allocation of beta assets that you will have today and have in 10 years. And you're going to make active bets, against that, or add additional diversification to that. And now you can actually measure whether your steps were in fact accretive, or were they dilutive to the actual long-term returns of your portfolio?
100%. And you're exactly right. And that was a huge part of the push for creating that. We called it a theoretically optimal portfolio. And you never quite get to it because you have constraints, and you're not ever 10 years in the future. You have, and you have a starting point and you're trying to move from there to something. There's a lot to that. But if that's your center point, then you can measure your distance from that, and you can start to justify your distance from that. And that starts to really be your set of active decisions. And you have to start justifying why you are no longer, and why you're not going in that direction, or why you're leaning against that, and start to think about how much active risk you're taking in those active decisions relative to that beta. It's a really, really helpful starting point. And it's a much, at least from my opinion, because this is what we kind of, put in place, it's a much better benchmark portfolio than almost anything else you can define. Like we talked at the beginning about the challenge of benchmarks. And if you have your CIOs responsible for investing at the total fund level, and you give them a benchmark that's 60-40, then it's going to be really hard for them to beat anything that's like too far off of 60-40, because you've made that their benchmark. And now that their definition of risk is tracking error to a 60-40. If you say your benchmark is the median manager, or the median pension plan, or the median anything that's going to look a lot like a 60-40 or an 80-20, or it's going to, at the end of the day, once again, they're centered around something that isn't necessarily the right starting point. And you go, how do we ever move off of that paradigm? And how do we move to something better if you're always getting benchmarked back to that paradigm? But then the question inherently comes, well, then what do you want your benchmark to be? And that becomes a really tricky question. But you say, like, look, this is a good center point to start thinking about. And you have to be careful that it's not too pie in the sky theoretical. Like it can't assume that you can do certain things that you can't in reality, like leverage requirements, or assets. There's not enough real return bonds on the planet to do what you want to do. It's like, well, that's not a fair benchmark. So it has to be like, it has to move back to reality a little bit, but like as a, as a benchmark construct that can sort of say like, I can measure and I guess the one other way you can think about benchmarking yourself, and this is like also super weird, but we also put in place a little bit, was benchmark each year to the start of that year. So, because I'm just trying to break the compare myself to the rest of the world or do what the rest of the world's doing. And now you can say, if I had held the portfolio that I started with for the entire year versus what I actually did, I could now measure my changes to some arbitrary starting point, which is just as arbitrary as anything else, but I can start to like, once again, focus on my alpha without contagioning it with someone else's definition of alpha, which is in their starting portfolio, which becomes my beta, unfortunately.
Right.
And I don't want my beta to be someone else's alpha as my starting point because that really messes up the whole decision.
Nothing more dangerous than having a false premise to start the whole discussion of 60/40 is your benchmark and beat the median manager. And that premise just contaminates every other decision down the track.
Yeah, absolutely.
And then it's
so portfolio construction
non-stationary.
at the total fund level is, it's hard enough as it is, but understanding that everything is affected by your benchmarks, like everything. And so trying to break the paradigm of, or like the worst thing, if you're a CIO, is some other team that's not you, like a risk group, creates your benchmark. And now you're like, well, who's the CIO? Because the most important set of decisions, the asset allocation, maybe even the amount of risk you're taking have been taken over by a different group. And now you're just like a long, short TAA around someone else's starting benchmark. And like, I believe the CIO should own the total portfolio, should own every major important decision. And so, and you can really see the challenges of that. But at the same time, you're a board member, you go, oh, wait, what? Are you completely unconstrained? And so then you can start to define, well, here's alternative benchmark, or here's a definition of risk, which is how much movement from where we were comfortable here to the end of the year. Like, and we were just trying to come up with alternative benchmarks that gave you the flexibility you needed to do the right things without giving you too much flexibility to constantly mitigate.
To do the wrong things.
Yeah, so.
The CIO's dilemma is just getting more and more complex and
It
difficult.
Is. That was a big part of the challenge was breaking that benchmark.
And another irony is that the fact that everybody is benchmarked to something is a big reason why a lot of sort of, alternative sources of return exist, right? Like, if the true definition of risk is tracking error and not the deviations in the value of the overall portfolio, then that is going to drive behavior that is aligned with minimizing tracking error, not aligned with minimizing total wealth variance. And that produces the opportunities that many alternative managers use to generate their returns. So, you don't want everybody to become enlightened and abandon their benchmarks, because then it has the potential to kill the goose that lays the golden eggs for many alternative managers.
But
Yeah,
don't we
I
need
wouldn't
some
say
people making
you're
mistakes
absolutely right.
too?
It's definitely one of the sources. It's probably not the only one, like
Yeah.
benchmarking, but it's definitely one where, and you could kind of like just argue, as I guess we have in the past, that it all comes down to anti-crowdedness, right? Like it comes down to when you have a bunch of people following some set of rules or some process or some benchmark, whenever too many people crowd into any particular area, the prices get bid up. And if the cash flows aren't affected by that crowdedness, because why would they be? The prices get bid up and the cash flow is the same and returns fall. Crowdedness is always going to result in lower Sharpe ratio, because at the same time as the returns fall, the risk goes up, because the possibility of that crowd all trying to lead together at the same time becomes significant as well. So crowdedness, of which benchmark hugging is a major one, is a significant source of potential alpha if you can avoid or take advantage of that crowdedness. So all that to say, if we backtrack and went inflation, and we can come at it from the alpha side, we come at it from the stock taking side, and whether or not, I know you kind of started with inflation, or you even sort of went back and said, look, are we micro or macro efficient? I don't know. Like these are interesting questions, because like in one sense, it really does look like we have massive examples where we've been incredibly macro inefficient over the last 20, 25 years, to the point of so obvious in hindsight, and maybe for many people, super obvious at the time as well. Um, and so you might argue then for micro efficiency, and I guess micro efficiency, that it's got one other thing going for it, which is like, as human beings, if you think about it for a second, like everything that we, like all of our senses are really good at relative, but terrible at absolute.
Mhm.
Like I go like, if you asked me what star is brighter in the sky, I could say that one's brighter. But, or what's bigger, like, or what sound is louder, I can do relative really well. And that's what our senses are built to do. We're terrible at absolute. I could not give you like any sense of how bright that is. And in fact, even our relative senses are like log scale, and like what seems like twice as loud to us might actually be 10 times
Mhm.
more decibels. And the same thing with brightness. But so like, we're quite good at saying A versus B. And so if you think of like micro as a whole series of like, you got specialists focusing on a small number of stocks, and you're stock picking, and you're going a whole series of A versus B and doing some sort of ordinal rig. That's probably what we're most comfortable doing as humans, right? And so we probably are very confident in our ability to do that. And we probably are quite good at orderly rank things. But then I guess like you got a bunch of things that might even be ranked correctly, but when the whole picture, the absolute piece, can just be miles off. And I think as humans, we're probably no good at the absolute piece. And so without something to anchor that absolute to, it probably can go off in extreme distances.
Well,
But
here's what we sort of came at it, right? We came at it from the perspective of two dimensions. One is um, portfolio agility, right? Like the big players out there um, just don't have much ability to take major bets, take major tracking error against their policy portfolio, right? Like taking major equity overweight versus target, or major credit overweight or duration overweight versus target carries a lot of risk. Whereas taking, maybe there's more tolerance for risk within the, um, individual asset classes, right? And then there's just the agility. Like you're swinging these massive portfolios around. You just don't have the ability to move quickly enough to take advantage of many of the macro or micro inefficiencies that exist, right? So sort of taking it down one level, I would argue kind of 99% of all cognitive and computational energy focused on investing is within the individual silos, right? So you've
yeah,
got the equity group, and you've got the credit group, you got the rates
yeah,
group, you got the
there's no
currencies
way
group,
the
maybe.
equity can tell you equities versus a commodity. Like it just doesn't.
Right.
The question makes no sense. And so, I think there's probably another thing that leads to micro efficiency as well is the stat art players. Like the ability to build a long short basket in ARBNet is infinitely more powerful than the one-sided arb of just trying to sell something you think is expensive or buy
Yeah.
something you think is cheap.
Yeah.
And
Cause
so
you
in
can
the
hedge the
macro
beta
space,
within the security space,
yeah,
right? But there's nothing to hedge
it's
against directly in the macro
and
space.
it's much slower. It's much lower bet. It's a much riskier bet. It's one of those things that you have to trust that a bunch of other people are going to come in alongside with you over time for it to work on your behalf. Whereas like in a stat player, you can almost do it yourself. So it's a very, very different risk profile. Um, so I think like there's a lot of reasons why you could think of micro efficient. I can also say like the last 3 or 4 years, like the micro efficiency argument seems to have like, if you get too many people, you've had a lot of craziness intraday. I mean, like think how much the market's changed in the last 2 or 3 years with, we were talking about the retail, like player just coming in and doing some crazy, meme stocks. But you also have like what's happened the last 3 years is like, I don't know how many day traders are still playing with cash equities versus the ones that are just playing with like massive, massive size of 1 day options. And
Yeah.
the ability for a small player or a small set of players to come in and like significantly move the market is changed a lot. And like these, I don't know why these things are like, it blows my mind that these are illegal, because it feels like if someone came in and fat figured the market to the size of the amount of manipulation, that's a market manipulation because he just hammered the market that hard. But if you went to 10 dealers and you bought, enough of these things and then just nudge it, then suddenly you've got a whole bunch of other people buying aggressively on your behalf and racing each other and potentially slamming way more into the market than you would ever do as an individual. You've given like this incredible weapon to,
Yeah.
to, to a small number of players. And it's been really disruptive at the micro and at the macro level, over the last 2 to 3 years. And so you can really see that's changed a lot.
Yeah, I mean, you
So
can almost corner the gamma market the way you could corner the silver market back in the 80s.
Oh, you're absolutely apt. Vol is such an interesting asset class, but it's changed so much in the last 3 or 4 years. You've got dealers now who are stuck, short calls, like massively, like in the market right now. And in the same way as, when you still think about this is, I think, fundamentally, and I think big pension plans kind of get this wrong too. They go, like, I'm being a good player when I buy a big put because if the market crashes, I make this money on the other side. And what you don't realize is an option is not really a thing. You buy equity, you bought a thing and you kind of know what you've got, but an option is kind of a promise by someone else to buy and sell on your behalf. Because when you buy an option with a dealer, they have to delta hedge it. And so on the other side of that trade, if the dealer's on the wrong side, the market starts to rise and they have to buy to cover that, the delta that runs away from them, they become a massive accelerant into the market. And same thing on the put side. And so if the dealers get stuck on the wrong side of that trade, which they do all the time now, this has been the last 3 or 4 years, has been a story. It's just quite an incredible force in the short term. And it can be an incredible short. And so you can really see a lot of market movement when the dealers are on the wrong side of their gamma exposures. Now they've started to reprice and they've started to figure it out, but it's been a real change in the market because for the longest time ever, it was priced by puts. And as such, there is this strong negative correlation between the VIX and the S&P. And that has gone positive at times. And the whole relationship between, vol and market moves is really transforming. And these one-day options are super interesting. They really transform things. But I would say that they are taking a ton away from microefficiency as we speak.
Yeah,
You see how the stat organs are able to pull that together.
Yeah.
Yeah.
So, okay. Sorry, Mike, look like you had something.
I think you're going to transition, just like I was thinking the same thing. You've got, if you're transitioning to sort of strategies and changes in the market dynamics and all that stuff,
more
let's dig
broadly
into
about
that.
diversification, right? We've done a lot of that on previous episodes. I wanted to really round it out, right? So once you sort of, we talk about stocks, bonds, and inflation hedge assets, right? I'd love for you to kind of rank for me, right? What are some of the other alternative betas or premia or whatever that, and I know it's always a continuum, right? From beta, alpha, and
Yeah.
you've already talked about that a little bit, but how would you kind of rank, where would you want to start as you're adding, completely different flavors to the portfolio in terms of what big players can actually allocate to, where the actual dollar size of these premia are large enough for a sufficient number of players to actually be able to participate? How would you think about, adding to the diversification of the portfolio, and in what order, if you could rank them?
Huh. So I guess there's a couple of things. So first of all, there's the diversification into assets and there's diversification into strategies. And even then I would say that inflation sensitive, it kind of has to be in between an asset and a strategy. I think like what you described as if it was just assets, then it doesn't do what you need it to do. And people aren't going to stick with it because it'll spike. But we're talking once every 10 years or so you need it. And then you look like a loser for 9 years. But if you can get strategies that can actually make money over time and give you that protection, you're miles ahead just because they're so much easier to stick with. And so, of the alternative assets to stocks and bonds are obviously, credit and then the privates. And that's a totally separate discussion.
But are the alternative assets, do we even need to go there? Credit, credit's short ball, it's capital structure. I don't know. I've argued on many podcasts and in many papers that credit's not even really its own asset class. Is private equity any different than equity?
So I've also made the exact same argument with credit. I mean, when we first tried to look at bringing it in as an asset class at the portfolio level. Like once you cover, it's got an equity risk, it's got a fixed income risk, it's got a credit risk, and it's got a shortfall piece, and it's got the liquidity. And once you take those pieces out of it, like as an asset class, it doesn't bring anything to your portfolio. But it's actually a very cool asset class in its own because it's not exactly risk parity, but it's a nice mixture of 4 different risk premiums. So it looks pretty good on its own. It just doesn't bring as much as people think it does to a total portfolio. But
Yes.
it's a really big universe for value add. And so there's a lot of room for value add within credit. And I think there's a lot of, so is it
Well, I
an
think,
asset class? Like
the
it's
opportunity is
a
to
space.
take a little away from the equity, right? And add a little bit to credit, acknowledging that credit gives you some of that equity exposure.
I mean,
and-
from a factor, so this was like, this is once again going back to the work we're doing with teachers at the portfolio level, but like we tried to get things into a factor perspective. And once you transform into a factor perspective, you go, like, if your factors are, either call it growth and inflation, or you call it stocks and bonds and some short ball and some liquidity, then you've mostly just like defined credit. You've also come pretty close to defining most of the factors that are in your privates as well. And so, when it comes down to a little bit of the time frame, privates are, like they are like they literally like they're definitely diversifying in the short term. So if you look at your 1 year, model, like privates, they look really uncorrelated because they're lagged and because they're smooth. And the smooth means you get to make up their valuations. And in some cases you really just make up the valuations.
Mhm.
And they're lagged because it doesn't matter. They're not in real time anyway. And so, those 2 effects are incredibly helpful for a CIO in the short term. They're probably not that useful for a sponsor in the long term. And so that's a call it like a classic agent management mismatch because the CIO gets paid on return on risk and anything that cuts risk that significantly and recently has been boosting return is super helpful. But it's not necessarily really accretive to the portfolio in the long term. So that's that's the trade, or it is in some cases, and it probably is at a certain size. It just probably gets over allocated to because it looks artificially diversifying and artificially less risky than it actually is. And so from that perspective, it probably gets over invested too. So illiquidity in general is probably over invested in portfolios, and it has some inherent sources of risk as well that you have to be super aware of. But if we say like let's set the assets aside and think about strategies, my gosh, there's so many. And I think if you're saying I'm going to invest in strategies or I'm going to invest in managers creating strategies, you got to split them into, I'm trying to think of the buckets you put them into. I mean, obviously, you break them down by asset classes and you break them down by holding period. I think is probably the starting point. And then you say within asset classes and holding periods, what have you got? And, holding period is particularly important because it's such a significant source of diversification, right? Like if you have managers who are trading intraday, or even in and out a couple times a day, they are for sure going to be uncorrelated with your managers that are holding for 5 days or for 10 days or 20. And they actually create, like at the daily level, it was like a different asset. Right. And so from a pure diversification perspective, that's super helpful. I mean, if you have a bunch of managers who are uncorrelated, all trading at the same frequency, let's say 10 days, then, if over the long period, they're doing different things from each other, they're going to look uncorrelated instantaneously. They're all either long or short the same asset at the same time for a given day. So whatever happens that day, they're going to look like they're either lost or won together. And this is one of the challenges with diversification over time, is that at some definition of time, you're not diversifying, right? I think we've talked about this before, but diversification sort of says we have 2 assets that are uncorrelated, then I get a square root of 2 reduction in my risk, like 1.4 times reduction in my risk between 2 uncorrelated assets. And that happens at like any definition of time. But if I have 2 managers that are uncorrelated over the long term, at some definition of time, they're either both long the S&P or both short the S&P, and that's actually not diversifying. That's additive. But at some definition of time. So at the 1 day level or the 1 hour level, your managers don't diversify; they add and subtract to each other. But over time, that turns into diversification. And so, it's very, very helpful to have managers that have different holding periods. And if you are building a multi-strat of managers, that's probably one of the things you start to think about to start with is how do we get different holding periods? And then what are the strategies? Well, what are intraday strategies, and what are the risk premiums of those? And then how do I collect them? And my God, there's a lot to think about bringing
And
it
what's the
together because
capacity of intraday too, right? I mean,
what's that?
conceivably, not everyone can allocate data. Well, not everyone can allocate anything, but intraday would be especially difficult for, to allocate a massive amount of capital to, or to even get a meaningful amount of risk into for many larger managers, presumably.
100%. So it's extremely hard from an oversight perspective. It's hard from a leverage perspective, a capital efficiency perspective. It's hard from a portfolio construction. So you see like multi managers doing it and doing it somewhat successfully. If you think if you're a multi-strat and you've got a bunch of these strategies together, I mean, if you think about this for a second, you go, one of the massive advantages to a multi-strat, especially if they're trading lots of different models in the same space, is netting. And I don't think, I don't think it's quite as obvious to people how, like what a big advantage that is. But if you had 10 managers and at any given point in time, some are buying the S&P and some are selling, well, then you don't get any netting, right? And you go, well, what is that worth? And the answer is it's worth like a shocking amount.
Massive
So
amount.
because
Yep.
massive amount because transaction costs are so expensive. And it's such a big part of any trading strategy.
Well, especially
And
if there's a performance fee on top of that.
yeah,
You're
yeah. And so
wrong.
like
You're
I
wrong
can,
on one trade and you're getting 80% of the other trade.
yeah. And once again, this is the difference between cancellation and diversification. But if you had only one manager's long the S&P 1 year and the other one's short the S&P the whole year, that's not diversifying. That's just you've got no exposure and you're paying fees.
Exactly.
100% certainty, one side versus the other. So that's the last thing you want. You don't want cancellation. You want diversification. Uh, but if you were to think about like, like let's say for us, we have like 20 models. And if you look at any one of these models, there's a couple really interesting concepts that come into play. Um, on one hand, you could think about it. You said like, imagine I was intraday playing and I had lots of different strategies that came, and I was running like what we call a complex event processor, which is responding in real time. It says like it's 10:02 and your trend following model said buy, or it's 10:14 and this model said do this, and if you just do all those in real time, yeah, you get that diversification benefit, but you lose all netting because you've said I'm trading this at this time, and you go and you buy, and then an hour and a half later you trade this one, and you're selling, and those don't touch each other, and so you're paying twice the transaction costs. If you can take all those trades and bring them together and trade them at, like, say, one time a day, well, then by definition, some are buying, some are selling, and you're going to net those guys out, and that's so you can net. So you take trading time, and instead of trading in real time, you compress that down to one or two or a certain number of times a day. Well, you've created a netting process, but the trade off is you're a bit slower in responding. And so like the question is like, how do I trade off like the speed of response versus the value of this netting? And you've got to quantify both of those. What's my alpha decay? What's my cost of waiting to do a trade versus my netting value? And it's quite amazing. Like for us, it's one of the assets that you think you have as a manager is like, if you only had one process and say it was a Sharpe ratio of 1, but like before transaction costs and it's making 10% a year, but your T costs 5% a year. It's like, well, that you have to think of that thing as losing 5% in trading costs. If you had 20 of those, and you went to bring that new one into your process, you might like literally net out something like 75 to 80% of the trading costs. And so that becomes much more accretive. And in fact, it's something that you have when you have multi processes is kind of this brand new, call it like an asset, this new benefit, which is that if I wanted to run this new process, if I was a single manager and this was the only thing I did, like it may not be feasible. But when I bring it in and when I net it with the rest of my process, like its T costs almost disappear. And it's a bit of a function of how big it is and how it turns and how it trades with the other stuff. But like it's quite amazing how much of those T costs can diversify away or just disappear into the process. Um,
This raises
whereas
another quandary, which we also struggle with because we also obviously run multi-strats. But so you've got all these different strategies. They even if you're trading them all at the same time, so you obviously you're maximizing the netting effect with that. But um, attribution gets really tough, right? So you've got different strategies that on their own, for example, may not be particularly accretive, but when you trade them with other strategies, because of the trade netting effects and the diversification you get within the portfolio, it's highly accretive. But then you've got an investor who wants to know where you generated your returns from, right? You could obviously describe that at the market level very easily, but going one level below the market level into the model level or the strategy level, that gets really hard, right?
Yep.
Because you don't know on a net basis how each of these constituents has contributed to the overall process. How do you guys think about that?
Yeah. So I guess there's a couple of points there. The if you do everything in gross space, if you do all your models, you say like I'm just going to take T cost as this thing that's charged at the very end. Instead of trying to attribute it back to the models, you can at least describe what the end of it like model process was before transaction costs. Because
Yeah, the
you
growth.
just can't. There's no way to take that final T cost and give it back to individual models, or you're wildly overestimating transaction costs, and I don't think that makes a lot of sense. It gets even more complicated if you're doing anything on top of the models, like any kind of portfolio construction,
Yep.
which we do, right? So and then it's like, well, like I like to let my models run independently, but every now and then, if every single one of them is long equities today, I'm going to say like I'm not sure I'm going to bet 20 times as much equity as one just because all 20 models like it. It's very infrequent and very unlikely, but and so like, there's going to be a point in time when you're going to lean against the aggregate decision, and maybe that should come at a negative expected cost and lean against the alpha process, but hopefully it's accretive on the risk side because like there are occasional times when when it wants to do that, you go those are super risky. Like if something happens in the market that one day, you could have a really good or really bad day, but it's pretty random. And
Yep.
so we say, well, we've got aggregate risk that we're trying to control, and now you're at the level of I'm mixing models, I'm netting models. I've got overlays on aggregate risk. And how do I assign those back to the models? And you just can't.
Yep.
And so the best you can do is I say is talk about the models in growth space, and then describe these layers and speak of them almost as if they're models themselves. Right.
Yeah.
This is a transformation process, and this transformation process, it transformed risk this way, and it cost this or it added this value. And think of it as a process that's a yield. It's in there because you think it's utility accretive, and then you always have to just pay attention to how much risk is in that thing relative to these things, and in terms of the utility that you're trying to provide from it, because it's from if you think of it as a either sharp ratio or utility enhancer, it's got to be um, uh, it's got to be either reducing risk or improving return or improving utility in some way that makes it accretive.
Yeah. And then
Um,
you're constrained in your ability to articulate the value of that trade netting too, right? Like, you know, it's it's actually important to be able to demonstrate, yeah, you could have owned 5 different funds with similar exposures, but your net return would be expected to be sort of 40% lower because you're not taking advantage of this trade netting. But articulating that in any sort of defensible, quantifiable way out is also very difficult. And then, while you can communicate this to institutional investors or, credited or qualified investors, then you can't communicate any of this like extra context or color to non-accredited or non-qualified investors, right? Who always operate at a major disadvantage to qualified investors who are able to then provide all this extra color, even though it's actually impossible from an accounting standpoint to describe the accretion from all these different strategy sleeves that are trading the same markets within the same account. So,
yeah,
I mean, it introduces all of these different complexities for different classes of investors that I think are counterproductive.
yeah. I mean, I think you can make a statement of if I had no turnover control and no netting, my trading costs would be X. And you could like we can do that calculation. That's like imagine these are independent managers, and you charge a T cost assumption to all of them. And you go,
But it's
boom,
just
what's your number?
it's an estimate,
It's always an
right?
estimate. Trading costs. It like when it comes right down to any time you do any kind of trade cost attribution, you're going to be estimating at that point. If you're going to try and put it back to models, you're going to try and do anything. You have your actual. This is the amount we actually paid.
Yeah.
And then anything else as an attribution back is going to be an estimate. But you can start with like, I mean, you like, and we do this. And so if we had no netting, what would our T cost be? And with netting, what's our T cost? And it's really interesting because what is the incremental transaction cost associated with adding this new model? And you have to say like, if we, even then, like adding new models, people always get this wrong, but you go like, I'm expecting this model to make $10 million because I'm going to put this much and I expect a Sharpe ratio of 1. But it doesn't work that way, right? It's like when you add a new model, unless you take your risk up, the new model doesn't get to make its standalone money. It's just how much did it improve your expected Sharpe ratio? Because if it only takes your risk up by 1%, well, you got to shrink the rest of the process by 1% to keep the same risk target. And whatever it's expected to make comes out of the other side. And so it always comes down to how much does it improve your expected Sharpe ratio. And you can also say, if I was running this amount of money, here's the total dollars I'd pay in T costs. And if I was just running this model alone, here's the dollars I pay in T costs. And when I add them together, I have the same risk. What is my dollars in T costs? And it's interesting because occasionally you can add models that have quite high turnover, and you can add it to the whole process and your transaction costs come down. And it has a little bit to do with the size of the model versus the stuff you're doing. It has a lot to do with what is the model buying when the rest of your stuff is buying. And so, if it's truly uncorrelated, it might add incrementally or it might take away, because every single time that the rest of the process is buying and this guy's on the buying or selling, you save some transaction costs on this, but you also save all this one. And so you can, it's quite amazing, but bringing stuff in that turns over quite high can take your transactions down. And suddenly, that's a huge benefit to a multi-strat. Like, it's a huge benefit.
Well, if you think about it, you're adding a model that has a trading frequency, and that trading frequency isn't going to be more, or it's unlikely to be more than all of the other existing models within the portfolio at that moment in time. Am I kind of getting that right? So you've got this high transaction model and you've got 20 models over here. It's unlikely that one model trades at a more rapid frequency than all of the other models. And then it helps inform those other models on their trading.
If you're not accounting for the averaging. Yes.
So it could trade more rapidly than your average. It has to do with how big it is relative to your average, because if you've got 10 or 15 and like at any given point in time, some are buying, there's called like the lightest level is a 50% chance that the rest of your guys are doing is in the opposite direction from this guy's doing. So like straight up the bat, if it's small enough, you can come pretty close to 50% of coverage. But that's just what this covers of this guy. Every time you do that, this guy covers some of this one as well. And so like that comes right back on the other side. And so if you measure the total savings, it's both of those together, you can get to 75, 80%. And so it's a pretty interesting reduction, meaning that if you found these 5 processes and 5 different managers, and they're each a Sharpe ratio 1, but like they lose 5% in trading costs, when you bring them all together, or if you bring 20 of these guys together, these incremental managers are coming at like 20% of the turnover, which is just incredible. And so we're not talking about the diversification of the alpha. We're talking like that. In addition to that is this massive reduction in cost, which is what you can see is like, and this is where, if you have these, I don't know, like a medallion, like who knows what they're up to, but assume that they're doing a ton of short-term stuff. And the danger with individual short-term stuff, once again, as we said, is that you don't get your netting. But if you do enough of it, and then you can aggregate it carefully into slices, you could probably get a ton of netting and just incredible diversification. So, time diversification is super important. And all of this was just to say, like, if I was putting together a multi-strat, you got to think about the different feature sets that you're diversifying across. And so you're diversifying across strategies and across assets and across time. And that's the 3 major distinctions. And to all of that, across strategies and time, you've got this netting thing to think about, or even assets and strategies and time, you've got this netting consideration, which is an important consideration. I went way off track on your question. And then you say, what are the big categories? And so at the global macro level, if you've got broadly speaking, you've got your carries. And so, obviously, like most fixed income models start with like relative or absolute carries, and whether they're risk-based or not is a big question. If they're not risk-based, then you're still going to end up with a bunch of betas underneath it. But like, some concept of carries, like obviously FX carries are a really big and well-known strategy. You've got the carries, you've got the values, you've got the qualities, and you've got momentums, and then you've got the volatilities. And like, broadly speaking, that captures a lot of them, and you can capture that set in all of your major asset classes. Then you have, like the other ones like merger arbitrage, classic risk premium, where it's, it's like the classic definition of risk premium, where it's like, like someone owns a company, It's trading at 20 and you hear that there's a merger announcement and it immediately pops to something. You go, what does it pop to? And like, obviously a lot of people spend a lot of time thinking what they think it should go to, but it goes to, it used to be a company that's prices moved, based on earnings and had a beta and suddenly what you own for a brief period of time is a coin flip. And it's a coin flip on the probability of this merger going through. The price popped from 20 to 30. And if the merger doesn't go through, I guess it goes back down to 20. If it goes through, it goes to something. That's usually a posted price. Like maybe it's 40. And you go, why is it trading at 30 and not 40? It's like, well, there's an implied probability of this deal going through. And so what you own briefly, you've just made $20. It was at 20 a day ago. Now it's at 30. And now you own this thing, which is no longer a stock. It's a coin flip. And you say, I don't want a coin flip. I don't want to like make or lose $10 on this thing that I have no understanding about. And I'm going to ask someone else. So someone else can take that trade off from me and they can own that, diversify, and I want out. It's a classic risk premium. So someone else will take on and say, I'm going to buy these things and I'm going to bet that there's a certain probability of default and at a certain probability of this thing failing, and a certain probability going through, and I'm going to price and size this thing correctly. And so that was, merger arbitrage is a very classic risk premium. And like, I think a beautiful one if it's done well, where I always saw it done badly is on the portfolio construction side, because like anything else, people like would tend to screw it up and market cap weight it. And they go, the size of the deal would dictate how much of it I owned. And the last thing you want when you're flipping coins is to bet 1,000 times more here. And then bet because at the end of the day, that's going to catch you one day, because the only thing that matters is the big one. And then the other thing to understand is that if you have a whole portfolio of these, you have a growing beta risk. And we saw this in 2008. If the market crashes or if you have a credit crisis or something happens, then all these deals, which you think are independent coin flips, can suddenly be very highly correlated with each other. And so that's like, you have in the background a tail beta risk in merger arbitrage as well. But like a great risk premium to add if you can find it. And I really ran through like quality. There's so many different definitions of quality across asset classes, within asset classes. Like that's a very broad statement. Same
How
thing
do you
with
think
value.
about quality across asset classes?
So I would say maybe not across asset classes. It's probably better to think of it as across sectors within equities, but it's if you think of, I think like I guess you wouldn't do a cross-sectional quality. What you would like, the best you would have is a time series definition of quality. And then if you had like a variety of asset classes with a time sectional definition of quality, some are higher, some are lower at any given point in time. And you can kind of think of that as a relative. You could even risk that guy if you wanted to. And we actually do have one model that does that, but it's like it's a very sloppy definition of cross-sectional quality. But it's, like a series of time series definitions brought together will have an over underweight across sectors and of a quality definition. And then, so think about FX for a second and say like the major risk premiums in FX would be momentum, value, carry, and then maybe some definition like country, like whether they sit in value or not, like value quality, and that would be kind of like a throw together concept there. But that like even that three-legged stool in FX is a pretty powerful starting spot. And then you always got your vol. And so
value would be sort of like relative to purchasing power parity kind of thing.
That's a very weak definition. Yeah, that's a good starting point. And it's a surprisingly decent starting point of a long-term definition of value in FX. And then if you think about, credit. So credit still has credit's complicated because as we said, it's a mixture of things. But, credit is going to have a term structure piece to it. It's going, and like the credit. So the interesting, when we first started trying to think about, when this was like back to 2006, 2007, we were talking about like bringing credit in the portfolio level, but way back before we were talking about bringing it into our risk parity. And so we were building our risk parity as a mixture of stocks and bonds and commodities and strategies across all these different assets. And when it came time to look at credit, we found credit is a super weird asset class. Especially if you're staring at IG, and this is back in 2006, 2007, but we're looking at it going, it's really weird because if you just invest in investment grade, if you look at the returns of that process over time, they're not very good. But meanwhile, if you go to the academic literature at the time, it was literally saying, like, we don't understand what's going on with credit. Why does credit pay so much Like it's the credit spread is paying more than it should. And there was this massive disconnect between what the academics are saying. Like, look, if you look at company by company, look how much, like, look at the probability default and look at the actual defaults and look what they're getting paid. And like, this is like, we can't explain why the spread is so rich. Meanwhile, the people investing in credit are making very little. And it was super unusual. I mean, it turns out the disconnect was most people, when they invest in credit, are either, for the same reason that you see that like the bond investors, they're trying to get some duration and they're sitting at the back end of the credit curve. And if you're saying like, I own credit, I buy a 10-year bond and then maybe by the time it touches 7, I roll it back out to 10. And if you're doing that sort of 7 to 10 rolling up process, which is where the vast majority of people sit, you capture almost none of the credit risk premium. Like you get all the risk and almost none of the fun. I mean, the Sharpe ratio there is almost nothing. But if you hold credit right through to maturity, which means that you're holding companies that like with 1 to 2 years of default and the other default or they don't. It's a very different structure, but if you hold it, that's where all the Sharpe ratio is. You go, that's super weird. And then once again, it was like early on in our research going, it's clearly a leverage issue because to get the amount of risk that you need and to get the exposure you need and the cash that you need to hold the stuff at the front end, like very few people hold bonds right through to right through to time zero. But if you do, that's where all the Sharpe ratio is. You go, why is everyone out here? And it's like, well, there's two reasons. And the first one is like, they're both classic crowded reasons. The first one is the vast majority of credit players are just rolling this process out, thinking they're collecting the risk premium because they're taking the risk without knowing that there's this massive kink in the curve because you've got these people selling here and buying here. And then the other side is like, it turns out that the IG credit curve is the discount curve for corporate liability for pension plans.
Yeah.
And so if you want to immunize your pension plan, that's the piece you have to hold. It's like, well, you should never be investing in a space where people are forced to be investors because that's going to be very naturally crowded. It's the last place in the world you want to be. But the vast majority of people playing credit at the time were out there at the back end of the curve where there was just like no Sharpe ratio and all the risk.
It's like the long end of the duration curve for the insurance sector and for the
exactly.
Yeah.
So, credit, like my God, like if you just wanted to outperform credit, all you would do is just buy from 5 or 6 years and hold it right through to maturity, like significantly higher Sharpe ratio. You go, is that a risk premium? Yes. Is it an active strategy? It's just different than what the vast majority of people are doing.
And all the ETFs, like all the index ETFs exposure to credit are all constant maturity. So they're all, that's exactly what they're doing. They're constantly rolling into new bonds around that target maturity, right? So they're just not collecting that premium.
Yeah. So, I assume this is obsolete information 15 years after we discovered it, but it's still, it's quite surprising where I remember working with the head of credit at the time. Because it was just one of those, like, we don't understand, like why would you just buy a rolled process of credit, constant maturity roll? Like, why is the Sharpe ratio so low when it looks like there haven't been a lot of defaults and we know that they're paying a lot? And the answer is, well, because it's like literally the curve has a pretty significant kink because this is where the buyers are and this is where the sellers are, and it's huge pressure points. And if you just hold past that, there's something quite interesting there. It's the same thing. We talked about this a lot. Like if all you're allowed to invest in is investment grade, well, then every time something gets downgraded, you're forced to sell it. And that's, that it's, you wouldn't sell it if you didn't have to, and it's a bad trade, it's a money losing trade. But across that, the constraint of if I own this name, once it's being downgraded, I'm going to get fired. And I'm happily going to sell it and I'm going to give that money to someone else happily. And that transfer of utility is a classic risk premium. So if you're an unconstrained investor buying the fallen angels, I think these are like 20-year-old well-known strategies, but buying the fallen angels is a very winning strategy.
And it continues to be, it's amazing. And like a number of managers come out and tried to launch these fallen angels ETFs. And I always look at them and go, this is such a great risk premium to own. And then they, a year later they delist them because nobody's interested.
Well, yeah, I guess the reason it exists is because people can't do it. I mean, it's like, as long as if you're an unconstrained investor, you absolutely should. Once again, these aren't really, maybe they're strategies. I don't know if you think about it that way. I mean, you're seeing just an absolute ton of overriding strategies that are coming into the market nowadays. Because they're index enhanced and to me, it's quite incredible, how much of these you're seeing. And once again, these are stuffing the dealers full of like just crazy amounts of gamma that they're trying to handle in the short game side. So it's just like, but those are very simple strategies. I'm not a big fan personally of every aspect of that, but if you build a proper, uh, vol selling process and size it right, like vol selling within FX, within equities, of course, is the main one. And to a certain extent, some in commodities, like there's interesting opportunities there. So if you think about like what are the major strategies at the very as I would have defined them back in 2006, 2007, asset by asset, you've got actually got let's call it like a low vol if you want to define it that way. Like where's the least leverage point within assets? You got a low vol piece, you got an eventual piece, you got a vol piece, you've got a carry, and you've got like some vol, some value versus quality definition. And then every major asset probably has some sort of seasonality or cyclicity in it as well.
Yep. Yep.
And so that basket is probably like the modern alternative risk premium basket. And then I would say next generation that we sort of focused on a little bit is like, well, what about the players playing those baskets? Because if there's all those baskets and all those players, and in many cases now the risk premium of the player playing the basket is stronger than the basket itself. And you'll see this all over, and like that's, by the way, longer term macro. ETF index anticipation, trying to anticipate names coming in out of the indices. Like you've got so many players who are so big and doing that in such aggressive size now. Like in anything, you can easily get more people offering the insurance than you have people buying it, and you can get caught on the other side of that trade. I mean, it's almost like I think a lot of those strategies which has sharps of 2 have just gone like -2 because very, very quickly it's like too many people tried to hoard toilet paper during, COVID, and then all tried to give it back at the same time. It's like you're literally trying to buy the toilet paper before someone else buys it, and hopefully there's enough buyers to buy it from you. But if too many people do that you can get caught holding your toilet paper, if you don't mind the analogy.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful. Thanks again. Now back to the podcast.
So I wanna highlight something that you said, but you kind of glossed over as though it's sort of a given. But you've got all these different premia. You talked about carry, and then you talked about FX carry. You talked about vol selling in equities. You talked about value, and most people think about value equities. And but you've got all these different, and typically you've got all these specialists, right? And you've got people who are familiar with value. They like buying cheap companies or cheap credits or what have you, right? But the real magic for vol selling, carry, doesn't matter. The real magic is in selling all the vol, is in getting all the carry, is in arbing all the value across all the asset classes, all the different securities. And, to the extent that you can then, trade against the baskets, there's a whole other level there. But just the kind of diversified global premium strategy, it's available. Well, it may not be available to everybody, but it's becoming more available every year. And most people just take little pieces of it, right? Like I've got a value tilt in my portfolio or a quality tilt in my portfolio, but it's purely on the equity side. When, if you're just into FX carry, that actually doesn't have a very attractive profile. It used to have a more attractive profile. Now the profile isn't attractive at all. But
It's probably coming back. I mean, there's
carry,
4 or 5 years there
fantastic.
where there was no carry signal because the central banks drove all the interest rates down to zero.
That's right.
I bet you there's fat carry right now in a lot of places, especially versus developed. Like, I mean, it's suddenly back.
Yep.
But yeah, that pillar of value and carry and momentum is pretty powerful almost everywhere. AQR
And
talks
the
a lot
magic
about
is
value
getting
momentum.
it from everywhere, right?
Yeah. And this is where I think systematic investing is interesting because, and like not to take away from discretionary players, like they have I think there's a really interesting marriage between discretionary and systematic, and because at difficult turning points or when the world hasn't looked the same, discretionary people have a chance to see into the future, and if they're good at that, they can add a ton of value. Where the systematic players may get caught in those structural shifts. But in a world of more stability, the systematic player and the breadth that just can't be beaten and can really do quite well. And so those two, they really do diversify at difficult times. But the expertise in systematic investing is in the systematic investing. And so you'll see that, if you do carry in FX or fixed income or equities or vol or credit, it rhymes so much across those that the expertise is in building the models as opposed to the asset class expertise required to go capture it. And it's the
Yep.
same for almost everything. I mean, I say if you're building a systematic model or manage it, you would never have a commodity carry expert. It makes no sense. And then you might want to talk to a discretionary commodity trader to make sure that you got all the pieces right. But at the end of the day, the commodity carry model is going to be 99% resonant to the FX carry and to the fixed income carry. And there's always going to be a little bit of like asset class specifics that you have to understand and know.
Yeah.
But once you pass that, the model building piece of it, and like the signal generation, the risk calculation, the portfolio construction, the putting all the pieces together, and like it should be the expertise is in the model building as opposed to in the asset classes is needed to capture that. And there's a little bit of expertise that the asset class require, but like, I think quite a bit less. And so, the systematic trader can capture all of those. In fact, I would say a small number of traders could probably capture all of those strategies all at once, pretty well.
Yeah.
And then you say like a discretionary investor could probably go in and really clean up on around the edges. And those two could be quite helpful together. But say like, how do you collect all those things? It's actually not as difficult as it sounds. I mean, I think if you started to build these processes and models like bit by bit, and like the advantage of systematic investing is once you've built a model and built it well, it just goes off and runs. It's like an annuity, and you can start to build the next one and build the next one. And you build 5-10 models a year. After 2 or 3 years, you've got a really interesting diversified suite of processes. And some of these can be built much quicker because like I said, they rhyme in such significant and obvious ways. And so, and this is not a new story. I mean, there's been a number of very successful multi-strat risk premium collectors over the years. Like anything, they're going to have good years and bad years, but and the space gets more or less crowded. As the space gets crowded, returns get driven down. But I'm a solid believer that the space will never get so crowded that it will never make any money, because like on one side, you've got people with actual demands who are like, they're always going to have the constrained investors. You're always going to have the investors who are in the spot. There's always going to be a flow of wealth. They're there and they're naturally there. You're going to have demands for insurance. You're going to have the players like creating the risk premiums. And if you've got other players collecting it, when too many people come in and collect, for a while, it can get to a very low or even negative. And then those players will leave, or the size will fix, or, all of that will normalize. And at the end of the day, because this natural demand is there, these players will need an equilibrium where a correct equilibrium risk premium collection process will and can exist on average over time. And the only question is, what is the expected Sharpe ratio of that process long term? It's never going to. We talked about this 4 or 5 years ago. It's never going to be as good as it was in the early 2000s because it was just too unknown at that point, and there just weren't enough people doing it. It's never going to go to zero because naturally these players will leave if it does. And so what is the Sharpe ratio that will keep players interested, and where does that balance to? And like it comes down to everyone always throws out a number. It's like, what's the Sharpe ratio per strategy? Is it going to be 0.25 or 0.35 or 0.4 or 0.5? And what is the Sharpe ratio at the aggregate process? Is it going to be 0.5 or 1 or 1.5? And I don't know where that settles. I would probably guess these things each come in at like a 0.25 and this thing comes in at a 1. But that's
Right.
an extraordinarily helpful, and I think people have been so spoiled by the equities over the last, 10 or 15 years. And they go, why? What? Like I can get that from equities. It's like, yeah, the equities are a 0.5 long term. And you just have to be careful with equities because like they make, very, very high Sharpe ratios for a while, and they make very low Sharpe ratios for a while. If you could find a proper 1 that you could put next to the 0.5 of equities and the 0.4 or whatever it wants, you'd be so happy long term.
Yeah.
But it's just one of those things and you have to buy into it, you have to understand it, and you have to trust over long term that it will be there. And I find that's probably the biggest challenge of systematic investing, is because people don't intuitively, it doesn't resonate with many people as intuitively, let's say like, I buy cheap companies, it's something really, really obvious and simple sounding. It's like, I buy things when they're cheap and they're on their way
I buy
upward.
$1 for 50 cents.
Yeah, I buy exactly. And you have to, you're trying to explain a little bit more, something a little bit more complicated. that when it doesn't go well, people lose faith in it much quicker. And you can have a value investor who's just been crushed for a year, and they'll come back and say, it's worth even more. Just trust me.
It's
And you go,
even
yeah, of
better.
course it is, because if it was worth that then, and say it's even better now. And like if the S&P falls 20, 30%, people don't go, it's never gonna make money again. They say we should pile in and buy it here. But there's a whole bunch of people who, if this strategy has a bad run, think, maybe it was never a thing, or maybe it never will be a thing, or maybe it's,
Yeah.
Maybe it's been armed away, or
Well,
maybe
it
it's been
comes
argued
down to
away.
that
And
that
even if it
decision.
has, like you can argue that, yeah, the expected return of the S&P is being driven down by until it finds
Yeah.
the level at which its expected return is positive. Like that's what any risk premium is doing at any given day. Is like the person led you to it is trying to find the marginal price where they're on expectation, their expected return is proper for the risk they're taking. Like, the marginal price setter is trying to determine the price at which their
Yeah.
expected return meets some required return on risk. It should be the same for everything. And so there's no reason, except if you have too many people trying to sell at the same time, or two people trying to buy at the same time, the price will adjust and move, and those players will come in and out. That should be a natural expectation of what this process is going to be. And it has a fairly long life to it. But that's fine. If your portfolio construction over the long term, you should be totally fine with that.
Yeah, you hit on something that we struggle with, or like the intuition of the strategy and the ability to stick to the intuition. So providing the extra underlying insights is incredibly useful, but sometimes still falls short when,
Yep.
and their friends aren't doing it, right? So you've got a little bit less intuition than you'd expect. You have a little less crowding from a cohort of those who you're maybe benchmarked against. It leads to some pretty
Yeah.
significant frailties
Well,
on
why
the
aren't you just
behavioral
buying
side.
NVIDIA? I think
Right.
is the
Right.
to come full circle. Yeah. So and look, like I think like what you guys have done with your what do you call it? Your like when you're layering in your alpha and your beta together, your return
Oh,
stacking.
return
stacking.
stacking. Yeah, return
Yeah, I
stacking.
think like everything old is new again, but like a portable alpha, it makes a ton of sense because there's an investor out there who goes, like, I can't face the benchmark loss of this underperforming the benchmark. And it's like, that's great. Here's a process that gives you the benchmark return plus this alpha. Just seems really smart to me. So I think that's a great product, and I hope that it has some uptake.
Nice plug.
Yeah,
We'll
appreciate that,
take
man.
it.
Thanks.
We'll take it. Now we are coming up on 5:00, or
Yeah.
we're coming up in the end.
Yeah.
And so are there any thoughts that you had that we haven't covered that you wanted to sort of put out there for investors to think about, things that you're contemplating that are hot on your plate right now that we haven't talked about?
I mean, I think we've covered a lot. I mean, like obviously I always have lots to talk about, but from the topics we've covered, I think we've covered them pretty well. And I feel like I apologize to people because I know I say the same things. We 2 or 3 times in, I'm probably repeating myself quite a lot now. But yeah, like look, I'm happy to do this. I love doing this. I love the conversation. I think you guys ask great questions, and I'd love to come back and do it again at some point.
Love it.
Well, you're a great guy to bookend the beginning or the end of a season. I can tell you that. There's whatever we have you on, they're clamoring for more, man. So we got to
Yeah.
keep them starved for more Schindler. But
Exactly.
Love
Save
it.
something for the next time.
exactly.
Okay, listen. Thanks a lot, guys.